Hello Value investors, thank you for joining me. My name is Michael from Deep Value Returns on Seeking Alpha. Today I want to talk about Zscaler. So Zscaler is a company that has been doing all the right moves in 2021 and it's growing quite quickly. So we're going to discuss its revenue growth rates, we're going to talk about its strong free cash flow generation, and then we're going to talk about its valuation. So let's just jump right in. So here's the thing. Zscaler is about to announce in the start of September its Q4 2021 results, and at the high end of its guidance pointing towards 40% year-over-year growth. But for all intents and purposes, this is a management team that has been very conservative in the past, and they're growing at a very rapid rate. It's quite likely that they're going to cross into 50% year-over-year growth rates. So this is the key takeaway. This is a company that's growing very, very fast. And unlike other companies in this space, its billings in Q3, the billings are a forward-leading indicator of the company's revenue growth rates, were up 71% year-over-year. So if we think about where Zscaler is in 2 quarters' time, they're going to be on a run rate of $1 billion in revenues. So this is a company that's growing at scale and is growing fast. So this is what we have to kind of keep in mind. Another bullish indicator that we have to keep is the backdrop that this is operating in. So Zscaler is a company that operates in the cloud, but it allows you as the user to work from anywhere. So rather than having to you as the user integrate yourself into a network and then from the network operate within that network and then come out of that network to go to other cloud sources, it's really a way to identify you as the user. And this is, here in the screen, you can see that on the left is that hub and spoke network that I've talked about just now, where you are kind of going into the network and then you're working within that perimeter, and the zero trust operation that Zscaler has, where it identifies you and connects you up to the right application at the right time. So this is something that it's just so disruptive to the old models, and it's offering the company a very strong tailwind. Another thing that I want to talk about is that it's clearly working well with its own existing customer base. As you can see, for Q3, its net retention rate was 126%. So altogether, you have strong growth rates and you got strong retention rates, and the ability to cross-sell to its customer base is strong as well. So all this is positive, obviously, and the stock, as you can see, is up quite strongly in 2021. Now, here's the problem. The stock, if we take out, so they're about to report Q4, so forget Q4, think about next year. So for its next year, it's priced at approximately 37 times next year's forward sales. That's very, very punchy. I wanted to put out 2 kind of cybersecurity peers, and CrowdStrike and Okta are 2 companies that traditionally have been quite expensive as well. And if you look at the example of, let's say, CrowdStrike, and we look to next year's revenue growth rates, it's priced at 29 times forward sales. So CrowdStrike was a company that last year in 2020 was doing all the right moves and was a crowd favorite, no pun intended, and it's priced at 29 times forward sales. So it's kind of come down slightly. If you want to compare with Okta, that's even more subdued, and it's priced at 21 times forward sales. So in this context, Zscaler is really an outlier here. You can caveat that and you can say, okay, yeah, Zscaler should be priced at as high as it is because it's a leader recognized by Gartner, and it also has very high free cash flow margins, hitting approximately 32% as of Q3. So this is a company that's growing quickly, has strong billings, and is incredibly free cash flow generative. At this rate, it's not entirely, the market is not entirely irrational at pricing the company so expensively, because its pricing point right now is kind of looking out to next year, but you're thinking about a company that has such a strong tailwind that the argument could be made that its near-term valuation is not that important. What's important is what is terminal value and how the company could be profitable in the future. But you can see right here on the screen, the company, even though it's growing at a very fast rate already, it's already also highly free cash flow generative. So these are kind of 2 sides of the argument. I think that the company is probably fairly valued already, and I'm not seeing enough here to compel me to take this investment right here. So I think that the risk reward is not that attractive right now. It's a company I do keep my eye on, but if you want to know what kind of stocks I'm looking at that I feel that are quite attractive, don't forget to check out my marketplace. It's called Deep Value Returns on Seeking Alpha, and you're welcome to do a totally free trial, so you have absolutely no reason to not get involved, and you can cancel anytime before the 14 days. You're not going to get charged anything at all, and we have a growing investment community, and you can check out the reviews on Seeking Alpha. I've got more than 30 reviews, all 5 stars, so you have absolutely no reason not to kind of check it out and see if it works for you. And I'm not going to replace you, that's not what I'm about. I'm about giving you a source of ideas. If you haven't got the time or inclination to kind of do the due diligence on certain investments, you come here and you check out and you pick out 1 or 2 ideas that work for you. And I am inclined to look at growth stocks, and I also look at value stocks. So it's really something to just provide you with more ideas.